What's up, tax fam? So, in our last video, we give you a little look into family trusts and why they could be beneficial in certain situations, especially if you're looking for tax-effective strategy and asset protection. If you haven't already seen it, make sure to check it out. But if you have, now that you have some background info on all features of a family trust, let's dive into the potential drawbacks of setting it up. There are around 7 steps that you need to follow when setting up a discretionary or family trust. Like following a recipe or assembling something you bought at Bunnings, you need to make sure you have everything you need before you start. When you're cooking or building something, you must follow the recipe or instructions to the T. The same applies to the trust. So, knowing these steps is pretty crucial, and it could get quite time sensitive and a bit daunting. The first step of setting up a family trust involves selecting a trustee or a few trustees. When deciding on a trustee, you need to consider the fact that they have an obligation to a duty of honesty, integrity, loyalty, and good faith. A trustee must at all times act exclusively in the best interest of the trust and be actively involved in any decisions. So right off the bat, you have quite a serious decision to make. You need to decide between appointing an individual trustee or a corporate trustee. An individual trustee is a person who manages the trust. This is a simple process, but it also leaves all responsibilities and risk to the individual. Under unfortunate circumstances, if the sole individual trustee dies or is not able to act as an individual trustee anymore, the change of the trustee needs to be done properly. Changing the trustee after the trust is being established can be very complicated and require professional advice to be done properly. The other option is to appoint a corporate trustee. In other words, you set up a company to act as a trustee. This can solve the problems associated with an individual trustee, but it will come at an additional cost. For example, setting up a company will cost you roughly around $1,000 and around $350 for an annual asset review. You'll also need to decide on an appointer. Most people aren't actually aware of what a appointer actually does, but basically, this is the person who has the power to appoint or remove trustee. They're essentially the guardians of your trust. You have to give careful consideration to this decision because it is a big one. Changing the appointer is also very complicated, almost impossible in fact. So you want to get it right from the start. Once you have decided on a trustee and appointer, you need to get a trust deed drafted. The trust deed is a legal agreement that describes how the discretionary trust will operate and establishes the trustee responsibilities. The third step requires a settlor to be appointed. The settlor is responsible for signing the trust deed and handing over the initial settlement sum to the trustees. The rule of thumb is that it should be someone impartial, like your accountant. They can't be the beneficiary of the trust because it will create an issue with the distribution. Once the initial settlement is made, the settlor is not really involved with the trust management or anything to do with the trust. Once all the nitty-gritty is out of the way and the trustee is formally accepted, the trustee will need to lodge the trust deed with the relevant revenue authorities such as Revenue New South Wales and pay stamp duty if applicable. They also have to apply for an ABN and a tax file number. Once that's out of the way, the trustee can open the trust bank account and is good to go. Now, there are a few things to consider once the family trust is operating. Firstly, although the trustee needs to distribute all the trust profit to the beneficiaries, they can't distribute any losses. If any of the trust assets end up operating at the loss will remain trapped inside the trust and gets carried forward to later years. The losses are then offset against future profits. Secondly, if any income is not distributed, it will get taxed at the top marginal tax rate. If you make any distribution to minors, you may be taxed at up to 66%. There also has to be a lot of attention to detail when conducting transactions. For example, when buying shares or investment property, it needs to be purchased under the trust's full legal name. If you only include the trustee's name, it can result in the trust not actually owning the asset. And I've often seen that it can take months and years before the beneficiaries realize it. It's not a quick or cheap fix either, so attention to detail is vital. Other potential drawbacks to using a family trust as a vehicle to purchase investment assets could come about when you're trying to refinance a property. Some mortgage companies and banks won't let you refinance your property unless you take it out of the trust first. You can do this, but when you move it back into the trust, you could attract a big stamp duty bill. Another common mistake we see with family trust is that members often forget to appoint backup beneficiaries. In an ideal world, you would want your trust to be for you and your children. But beyond this, you probably haven't given much thought to appointing backup beneficiaries. Now, let's say you and other beneficiaries of the trust are all in the wrong place at the wrong time and tragedy strikes. The only beneficiaries of the trust have now died, and the trustee now holds all the trust income with no one to distribute it to. So, having a few backup beneficiaries is more important than you think. And then, lastly, you have to remember that each year you have to organize an annual general meeting before 30th June with all the beneficiaries to decide on how the distributions will be made. Sometimes this comes with a little family drama if no one can decide on a distribution resolution. It would help if everyone knew what to expect going into the meeting. Oh, and before I forget, obviously, you have to keep in mind that running a trust is not a cheap exercise. So, it needs to make a complete financial sense to establish one. To give you an idea of the cost, you can expect to pay just over $2,000 for initial setup and around $3,000 for annual trust accounting fee. If the trust holds a lot of assets with complicated transactions, this fee could go up to around $7,000. So there you have it. Hopefully, now that you have a clear idea of what it takes to operate a trust, you're in a better place to make an informed decision about whether a trust structure will benefit you and your family. But remember to always seek professional advice before diving in. If you're unsure about anything we mentioned in this video, feel free to leave us a comment below. Otherwise, I'll see you next time. Thanks guys!